I would like to move to our next panel, which is going to be, an introduction to some of the work that we've done at the Clean Capitalist Leadership Council and also Grace Richardson Fund that relates to the questions that we're dealing with today. We're going to be looking at clean tax cuts as an incentive for competition. And I don't know if everyone here is familiar with the clean tax cut concepts and the various ideas. So let me just unpack for you, how these came about. As I mentioned, at the beginning, one of our insights in 2016 that we brought to the table is that marginal tax rates for profitable, clean infrastructure deployment could make a lot of difference. And one of the things that's really interesting about it is that you're doing stuff to accelerate the private players. You're going to be accelerating competition versus the monopoly. If those incentives are available for competitive players, not monopolies, that will make a difference. We had a number of different frameworks for clean tax cuts initially. In the automobile sector, the average vehicle fleet emissions is one number that captures all of the information on sustainability, and it's well reported. So you could take that and use that as a tax modifier, reduce the taxes on business income taxes and investor taxes. And that would be a way to motivate behavior from the boardroom to the shop room floor. But one of the best ideas was proposed by a gentleman named Travis Bradford. Let me just tell you about Travis's innovation on the clean tax cut idea. Travis, he said to me, Rod, it's true that the automobile sector and the power sector have good solutions that can be advanced with equity side tax cuts, but they're on the demand side of capital. And if you take your supply side idea and put it on the supply side of capital and go to the capital markets for project finance, you're going to have some very interesting double-barreled impacts. So he was talking about tax-exempt debt, tax-exempt bonds, tax-exempt loans, and how these would accelerate clean infrastructure deployment.
Sure. Yeah, and I'll keep this very brief because I think you have taken this idea and really expanded on it in a lot of important ways, and actually making it very detailed with respect to the actual way that such a program can be structured. But the basic intuition is that the energy industry is one of the most capital intensive industries in the world. If you look at really the economics of how things play out, not only is it capital intensive, but it's increasingly so, particularly as we replace fuel-based energy generation, electricity generation with things that are far more capital in terms of their initial upfront cost. And so this capital intensive industry is getting more capital intensive. And if what you want to do is to induce people to put more of that capital to work, you actually need to try to drive down the cost of that financial capital that you use to amortize. I mean, and we all understand this when we've all bought long dated assets, even at low interest rates, a mortgage on a home or anything else. If you amortize something over a multi-decade time frame, the vast majority of the cost is actually in what you pay for the financial capital and not for the underlying physical capital. So even basis points or tens or hundreds of basis points in terms of which would be the result of a tax exempt structure for bonds and other forms of capital that you've expanded on in other places, it would have a meaningful impact in actually the delivery and the cost of delivering those energy services out of that capital. And so at the same time, what you're doing is you're making sure that the after-tax rates of return for investors are still high, but the cost of borrowing and the imputed cost of using those energy assets is low to the users. And that one change alone would have massive impacts. And if you look, I think from the point of view of stimulating markets, the amount of additional labor, construction, jobs that go into deploying that capital, you could actually see a meaningful payback, if you will, in terms of the loss of revenue from the upfront tax abatement of the capital that in other forms of revenue. And I know you've done some estimations on this, is that it could even be more. So it'll be interesting to talk more about this, but that's just the general intuition.
To underscore why these are so, what we call these is clean asset bonds and loans. They basically are tax-exempt debt that finances a range of clean infrastructure. By driving down the cost of the debt by maybe 20 or 30%, you're driving down the cost of clean electricity, clean cars by a similar amount, because the cost of debt, cost of capital is so important in these projects. So you're getting a double-barreled impact of increasing demand and increasing supply at the same time. But you're also getting another double-barreled impact, because by driving down the cost of capital, you're applying a tax cut directly to financial leverage. And by doing that, you're driving up the return on equity, so that you're attracting tax-exempt debt investment and taxable equity investment at the same time. And this is extremely important for a clean infrastructure project, because most of these projects raise debt and equity at the same time. So you're doing something that is both very, very much more participatory than using tax equity, which only the largest players can play in, because it's so complicated and it only really benefits people with a huge tax appetite. But this is something where mom and pop, investors can play, and the debt side or the equity side, everybody can play. Smaller entrepreneurs can take advantage of it, but also it's incredibly cost effective, because you're giving up the tax expense where the revenues are low and taking in tax revenues where the revenues are high. In the US, average return on debt is about 4%. Average return on equity is about 13.6. So that means on a 50-50 capital stack, clean asset bonds and loans and equity, you're taking in 350% more revenue on the equity side than you're giving up on the debt side. So that might be an extremely cost-effective way to go about using an incentive like this. But Steve, we put this together with the help of the American Council for an Energy Efficient Economy. Steve Nadel is the executive director, and he's helped us with the initial charrette on how to apply this in real estate, and then how to take all of the different ideas that we developed for clean tax cuts and put them into a federal legislation package. And the idea that ended up rising to the top was this clean asset bonds and loans idea. And Steve, why don't you explain a little bit about the different areas that are different kinds of technologies that are covered in the Clean Free Market Act?
Happy to. Thank you. So yes, we try to include a lot of different types of clean technologies, but you have to define them very concretely, or else. So we tended to use existing legislative definitions for various types of centralized renewables, for nuclear power, for combined heat and power, for carbon sequestration, electric vehicles, fuel cell vehicles, batteries. Also included zero energy homes and buildings using some DOE definitions and deep energy efficiency retrofits. So we've come up with, I think, a tightly defined package and developed legislative language. We're now trying to get this introduced. The challenges have been thus far, Congress basically has not authorized tax-exempt financing for private entities. There are some provisions where a local government can direct the money to a private entity, but they always have some type of government body entrepreneur. And when we talk to, Finance Committee, Republican staff, they're reluctant to go there. So we have to overcome that obstacle. The other obstacle we have to overcome is there's an awful lot of renewable energy and electric vehicles that might happen anyway. So providing them tax-exempt financing is expensive. And as people will know, Republicans are reluctant to spend too much money. So that's something else we are thinking about. How can we tighten eligibility?
Thank you, Steve. One of the points about this particular framework is that, yes, this would be a powerful way to incent competition, because it is something that really benefits the private developers, especially, who can react to this in a very entrepreneurial way. They see it dynamically and differently from how a state-run enterprise might see it. And so, Jigar, why don't you explain to us a little bit about how, as a entrepreneur, you would use these? What business model would you use to deploy these most effectively?
Well, I think that, what we care about is liquidity. And I think, as you and I have talked about before, the tax-exempt debt market is actually a far more lucrative and far more forgiving space. And you see that in the solid waste space, where a lot of states actually issue their own tax-exempt solid waste bonds for biofuels projects and recycling projects and all sorts of things, right? So I think once there is a market that doesn't require a PhD in the complexity of how to use those tools, like there is at the state level for the solid waste bonds, you could start to see an open marketplace to use these. And that then allows technologies that have that are misunderstood, that are less sort of mature, to fight equally for the right to participate, right? And today, for instance, fuel cells, I would suggest, are very mature technologies. They have access to a 30% ITC, but the investment tax credit buyers don't want to fund fuel cells because they're just so used to doing solar and wind. They don't want to figure something else out. But the tax-exempt debt market doesn't have such qualms. For them, all the paper looks exactly the same. I think they're very much interested. I would say the same thing is true for energy efficient buildings, right? Which has had a hell of a time monetizing 179D credits. And so it really hasn't played the role that it was supposed to play, but you could imagine getting access to this sort of tax-exempt municipal debt market would be a game changer for them. So I think part of this is really just opening up the scope around where people feel comfortable, putting their time and effort into financing sustainability solutions that are outside of solar and wind.
Jigar, you've mentioned before about the number of projects which would pencil out, and how this changes the number of projects. Can you explain that, and also explain a little bit, what Generate Capital would do with these instruments?
Well, Generate participates on the leading edge of sustainability, right? So we're one of the largest investors in fuel cells, anaerobic digesters, renewable natural gas, combined heat and power, behind the meter battery storage. And so when you think about all these technologies that are basically all misunderstood by the broad commodity capital marketplace, they're also misunderstood by the broad debt marketplace, right? So the debt marketplace generally views credit as hell or high water payments, as defined by commercial banks, not project finance. And so when you think about what it would do for the cost of capital for all these sectors, it would drop them dramatically. we talk to 600 entrepreneurs a year and log all that effort. I'd say right now we probably have seen about $75 billion of projects that are actively underway in all of these sectors. And one of the challenges is that they get arrested in their place because the final financing solution isn't in place, right? So if people don't have confidence what the final financing solution is in place, you could imagine that development capital doesn't go into those markets, right? Because the way that development capital gets funded in the end is by knowing that the final offtake capital is there once the project is fully developed. And so I would say there's probably 70 to 75 billion dollars of the projects that we've seen that would be unlocked by, a policy like this.
So unlocking far more projects is one of the chief benefits of something like this. But one of the things that this does is it helps to speed the deployment of technologies that are scalable, which is important to do. And by incentivizing competitors and competitive markets, it also incents innovation to the degree you have a bigger market. It means that when a entrepreneur like yourself looks at a new innovative technology, what you look at is what's the market potential. The market potential is bigger if the more markets are open and the market is bigger, right? So, one of the things that is important to do as well is to make sure that we are incenting early stage innovation, in the right way, in a smart way. And, these clean asset bonds don't directly incent that, but other folks other than, the Clean Capitalist Leadership Council have been dissatisfied with traditional incentives and have pioneered some new ideas. So I wanted to turn to Jeremy Harrell, who is with ClearPath. Thank you very much, Jeremy, for co-hosting with us. I'd very much like you to explain how the ESIC is a departure from traditional subsidies and more tech neutral. This is another idea, and how that plays into the ClearPath vision for global markets.
I think that we're having a good conversation here about the dynamics in the marketplace. As we look at energy markets currently and look towards a drive towards a clean energy transition, we see a massive gap in the technology scale up among the technologies that exist currently that need to be done to meet emissions reductions, and a huge gap in the technologies we need globally. Ultimately, this is just one study, but IEA has forecasted that the technologies that we need to meet emissions reductions to meet some of these mid-century deep decarbonization goals. 35% of emissions for those, 35% of the emission reductions that we need come from technologies that are only in the prototype or the demonstration phase, and 45% of those comes from technologies that aren't widely deployed. So there's a clear gap here across the economy, and that's not just in the power sector as a whole, that's across the sectors of the economy, of being able to bring these technologies forward, make them cost competitive, and let the free market take off. And so as we look in trying to find ways to bridge that gap, how do we get initial technologies deployed? I think there's a lot of different things along the paradigm that we need. As we look at the power sector here in the US, that's what the Energy Sector Innovation Credit's looking at doing, is we look and say, okay, we want to scale up a broad suite of technologies, and we don't know what those technologies necessarily going to be. There's proposals out there to say that we can, if we have breakthroughs in storage, we can get to higher penetrations of renewables and combined with long duration storage. Great. If we need to use carbon capture with natural gas, advanced nuclear technologies, flexible firm geothermal technologies, we're kind of agnostic on the technologies front on the path towards deep decarbonization, but we are not agnostic on the attributes that we need for the grid. And so the Energy Sector Innovation Credit is specifically targeted at just that, the attributes that we need from generation assets in just the power sector. This is the power sector centric proposal, and moving it forward. And we try to get at some of these dynamics that are a challenge in competitive electricity markets. And to the point that you were making, Rod, of how do we make this usable for a broader suite of taxpayers, right? Because the way that traditional investment tax credits and production tax credits, like the solar PTC and the PTC, you either have to have some type of middleman on the financial sector side for these, or you have to have a big corporate that's got significant tax appetite, right? And so the Energy Sector Innovation Credit is let's see, I want to show one slide here, but it's not letting me demonstrate it, but it kind of gives you exactly those points. How is it different from existing credits? One, it's technology inclusive. It's focused on attributes, not necessarily the generation type. So it's not an investment credit for X or Y technology. It's about emissions reductions in areas, and it's in the performance of the asset and what it provides to the grid. Two, it's not a price per kilowatt hour like the wind production tax credit, for example. It's a credit based off the percentage of revenue you get from putting electricity on the grid. And so that makes it so it's not distortive like we've seen the PTC be in wholesale electricity markets like PJM, for example. You're not getting negative pricing events. You're essentially incentivizing power where it's needed most and when it's needed most. And so that's a key difference. And then, getting at the sort of principle, in the end, this credit is not meant to be a deployment subsidy in perpetuity by any means. This is supposed to be a robust incentive to bridge the gap between deploying things out of the early stage, whether you come through the labs, you come out of academia, you come out of entrepreneurs trying to deploy things early, and get you to show that you're commercially viable, learn by doing, so bridge the gap. Whenever we build something, it's always going to be more expensive the first time we do it, and we learn by doing, right? And so the credit is most robust at those early stages when you barely have been deployed in the commercial marketplace, and the credit goes all the way away once that technology represents somewhere between 1% and 3% of the electricity grid. At 3% of U.S. generation, it goes away completely, and you're ineligible for it. So tries to get at some of those key areas where, one, we've seen previous policies fail. Two, make it more attractive to a broader swath of taxpayers. And three, not subsidize stuff that's never going to be commercially competitive, because ultimately we think that clean has to be cost competitive with its alternatives, right? That's how we truly deploy globally these technologies. As we look at the developing world, there's many places where we don't have the luxury of making the choice between attributes like clean and purely providing power to people. And so these technologies need to be cost competitive, and that's what this policy is trying to drive at. It drives at that specific purpose. It's not an end-all be-all, and it's why I think it's a piece of the larger financing puzzle that's going to be needed to drive global clean energy transition.
Yeah, thank you. Jeremy. I'm not generally a fan of tax credits, but this seems to be a huge improvement over the older style tax credits that are technology specific and don't phase out and reward the wrong things. So, to make things that are level technology neutral and phase out this way, it could be something that works in conjunction with clean asset bonds and loans to make sure that you're bringing new technologies and entrants into the market, and when they're mature, they can play with the rest of the competitors, making those energy markets even more competitive. With more choices for different kinds of cleaner generation and maybe even clean base load, which is the holy grail of what we're really trying to get to.
Right.
So,
yeah, and I'd be really curious to hear from Jigar in particular, and maybe someone else, of how they think these tax dynamics are playing differently in the current state of the economy. I mean, we're hearing from a lot of folks that the cost of capital is dirt cheap at this point, and so how has the COVID economic slowdown changed things? How have the current economic conditions change what the need is, particularly here in the short term? Because I think, one, there's going to be a huge policy opportunity here in the next 2 to 5 years of how do we get out of this kind of significant economic downturn that I think is unprecedented in how it's impacted the wide swath of the economy. And two, how does that turn on the head some of the economic assumptions that we've been thinking about, and frankly, were challenges that we were looking to tackle that may no longer be the challenge and forward. So I'd be really curious to hear from folks like Jigar who are financing these projects, how things have changed as a result of kind of the current state of affairs.
Well, unfortunately, we will have to pull you into a conversation with Jigar later because he has had to go to another thing that he has to do. So he was only with us for the first hour to warm us up. But I do want to say that, one of the key things about the ClearPath vision as enunciated by Rich Powell in front of the Ways and Means Committee, you've been very strong about how, we need to, innovate technologies and then sell them around the world. I think what we're trying to do here today is think about ways to bridge the policy gap between innovation and selling it around the world, opening up markets. And we're going to be going to a brainstorming session to think about opening markets in 5 minutes. We're going to take a 5-minute break now. But as I promised, Guillermo, while we're taking a break, people can, go do what they need to do. But in 5 minutes, Guillermo, please explain what is the challenge you're facing in Honduras right now? What is the threat that your opening up of the power market is under, so folks can understand what we're up against?
Sounds good. We'll be ready. 5 minutes.
No. Go ahead. Do it right now. You know, people will take a break if they need to, but I wanted to fill up this time, use our time as we can. So we're on a break. If people need to take a break, go ahead. But you explain it and people. I'm sure the people who are interested will stay on.
All right. Well, thank you. So we in this past year, once the system, I was telling you earlier, the system operator came officially into effect, or in charge of managing the system, dispatch and setting up the spot market in June of last year. So we've only been, I would say, fully functional with for just over 12 months. Hiring people, hiring technology, or contracting technology, and starting to train, I would say, some of the new agents in the market. We started the large consumer, we call them Qualified Consumer Association, which I currently have the seat inside the system operator. That gives me a really good angle by being having to wear the hat for qualified consumers. As as consumers, what we want is reliable power, access at the lowest price possible and at the highest quality possible. So with that angle, it's a good way. We needed that association and these large consumers to come into the market to balance the market process and to set up the buy side in the system. Companies, large businesses are not used to having an energy department within their operations, or hiring and negotiating with generators or wholesalers. So this is a big process that's going on right now. And as I said earlier, I'm happy to say that after months of regulatory work and meetings, this week the first qualified consumer was approved as a registered agent by the regulators. But I would say some of the difficulties that we have are kind of retraining the financial system to understand a competitive energy system in order to how to finance new projects or expand current projects without a permanent purchasing power agreement with the state power utility. Another difficulty is getting the general public to understand that the change in the energy system, the deregulating the energy system and opening up for competition, means that the general public also has to start trusting the new system. And in order to create trust, what we've been doing, I'd say, from both the regulators and the system operator side, is publishing as much information as possible, allowing for the participation from agents into the regulatory process and the new normatives, putting out data, which some of you might be surprised, but it wasn't until I think it was November or December, probably around there, that for the first time the system operator made public the real-time aggregate energy demand for the whole country by technology. And just putting out that information, it used to be a state secret. Having that information within the state power company was a state secret, and now it's publicly available information. And that's the type of work that we're doing, is how to build trust in a new system where people and actors don't really know how to function. So I would like to
Guillermo, if I may, what I we don't have a lot of time for this, so if you could very briefly, what is the threat right now from the operator who got the contract, the 12-year contract?
So what the threats right now are to finish with the way things were being done before. So one of the things now is that all contracts, or anyone that wants to sell power into the system, can only do it through two ways. or an international bidding process that is supervised by the regulators, or a spot market process, which is, you don't have a contract and you're totally open into competition. That's selling into the grid. But if you want to have your private contracts, now you can do with the large consumers. So those are the only two ways, and we have to protect that all contracts go through this institutional process. If we are not able to comply with that, then we're weakening the institutions that are just starting to mature. Would this be the right time to get Jose and Kevin's input into some of these difficulties?
Well, we just need to, like in 1 minute, tell us about exactly what's going on with this new contract, the emergency contract, and how that threatens the system. Give us, because we really have to move to the next section.
Okay, so the contracts, as I said, need to go through a authorized regulator process. And we have a case right now of a process that did not go through that. And because it's in an area that needs attention, there's an energy deficit and outages in the sector, and the community and businesses are in need of stabilizing that grid. So that need from the local population gave congressmen the opportunity to be able to push for contracts in a way in which they thought were fixing a problem. So if we don't move the market system fast enough and mature these new institutions fast enough, then the political process reaches back and bites us again. And in order to prevent from the political process, which becomes not a technical issue and becomes a how to solve or win the next election for a congressman or for any mayor or any other politician, then what we need to do is move fast with the right advisors, with the right technology, to create as quick as possible trust in the new bidding process system, and have that energy come in and be delivered to solve the energy crisis in the country, which this summer we had another, we've been rationing power for the last several summers during the dry season when all hydros and wind basically go out of service.
Right. So just to summarize, one of the things that's going on right now for you is that there's been this emergency contract that's awarded that basically violates the competitive market process. And because it's expanded from 3 to 12 years and uses bunker fuel instead of even diesel, it's extremely dirty. And it's also, perhaps threatening plans to introduce upgrades to the transmission lines to allow for cross-border competition. Is that a good, correct summary of what's going on?
I would say, yeah, that's accurate. What we need is because even though the contract isn't huge, the important is to protect institutions, because once you have the institutional process safe, then the predictability in the system is better. And that allows for new projects to be financed, and not only in the generation side, but for the first time, we're preparing to open up for private transmission operators, which we've never had that. Guatemala and El Salvador already have that, but having that will help us, because according to the budget set in the State Power Company and the loans that they've gone from international funding organizations, they can only reach for almost between a third and a fourth of the financial needs that the system needs in order to stabilize the national grid. So there's a lot of space for private investment, and in order to provide space for private investment, we need to make sure that institutions are safe and functioning as quick as possible, but with the right signaling as possible, in order to be able to provide the trust that private investment needs.
Great. So we are going to move now, Guillermo, thank you very much, to a discussion, the part of our session that deals with brainstorming new free market incentives and trade strategies to open markets faster. So we'll be looking at US proposals and also maybe even international proposals, and throwing out in a rapid fashion ideas, but hopefully some of those ideas will deal with how to protect, and encourage the kind of market reforms that are going on in Honduras, but also keeping in mind that, look, these processes are under threat, by companies that don't want competitive markets, that still want to do things by getting, Congress to subvert the competitive process. So what can we do?